Hello, everyone. I'm Mark Hart, one of the founders and director of investor relations for MIP Capital Partners. We're excited to formally announce that our BTR Fund III is now live, and we are actively raising capital with our accredited investors on this passive income opportunity. Before we begin, I'd like to introduce our presenting partners today. We have our founder and CEO, Matt Sinclair, as well as Andrew Glisson, Director of Strategic Partnerships. The outline for today's webinar will be a summary of the investment opportunity. Then we'll touch on the key investment highlights. And finally, we'll conclude with the next steps for those that would like to invest. Note that in the investor portal, which we will discuss at the end of the presentation, we have a much more detailed version of this presentation, which is available for download. We have carefully selected a portfolio of 36 Class A new construction single-family residences in suburban markets of Memphis with top-rated public schools. Certain suburban markets of Memphis have been heavily underbuilt but are experiencing rapid population growth. Class A new construction rental properties in these suburban markets are in extremely high demand, and Reedy has had a considerable amount of success with attracting high-quality, long-term tenants for these single-family homes. We will be purchasing the homes once completed through partnerships with best-in-class local home builders, where we have established long-term relationships, and we have been very selective regarding specifically which homes we will purchase. We are under contract to purchase the homes currently, and due to the purchasing power and size of the fund, we have created a 10.2% discount from list price to benefit investors. We will close on the homes once they are built, as the fund will not be taking on any construction or development risk, and we will be placing long-term renters in the properties immediately. The investment is designed to provide consistent and dependable cash flow to investors paid on a monthly basis. The cash flow is enhanced through real estate private credit, which results in significantly more passive income for investors if they decided to purchase a property directly. We'll be raising $5.8 million from investors in this 506C Regulation D vehicle, and we have designed the investment to have multiple exit strategies for flexibility, and we plan to sell the portfolio in 5 years. We'll have a conservative debt structure on the portfolio, estimated at 68% loan to value, using a non-recourse loan. Investors will share in significant tax benefits, as we'll be utilizing 100% bonus depreciation and cost segregation studies, of which the deductions will be experienced meaningfully in 2025 through a K-1. The management team is highly qualified, as the Reedies have over 50 years in the Memphis market, investing and managing rental properties, coupled with Matt Sinclair's 15 years in private equity and investment banking. Together, we have created a vertically integrated platform which gives us more control from asset selection to top-rated property management, which results in quality risk-adjusted returns to investors. Investors will be able to choose between 3 different equity tiers to align with their specific investment goals and preferences. Class A is pure cash flow. It's projected to receive a 9% cash flow paid before all the other classes and is ideal for those looking to create a steady stream of income while reducing their risk. Class A does not participate in a profit split upon sale, but it will receive tax benefits. Class B is equity and cash flow, and will receive a 7% preferred return and 80% of the profits at sale. We enhance the preferred return by offering an additional 3% accrual return, which is paid once we sell the portfolio, resulting in a 10% total preferred return. Once the investors receive their 10% total preferred return, then the remaining profits will be split 80% to the investors and 20% to the general partners. We will also be enhancing the cash flow received during the capital raising process by offering an additional 100% of current preferred return to investors in the form of a catch-up distribution. If an investor decides to move forward in September, they'll get a 14% preferred return starting the day they invest their capital, and it will be paid as a lump sum in cash once the properties have closed and our long-term debt has been put in place. This is estimated to be in February of 2026, and the earlier investors commit, the greater their benefit. Finally, Class C is similar to Class B. However, it is designed for large investments over $250,000. These investors will receive a 90% profit split and have an 11% total preferred return. We're also personally making a substantial co-investment alongside the LPs to ensure the alignment of interest and because we have an extremely strong conviction in our business plan. Due to the discounts received and private credit cash management strategy, we're able to achieve high core plus returns with a core risk profile, which means the fund has favorable asymmetric risk-adjusted returns. The average annual return for Class B and C is 14.9% and 15.6%, while the average cash on cash is 7.4 and 7.5. The multiple of invested capital is 1.8 times, which means on a $100,000 investment, we project to give back $180,000 plus over the 5 years. We are formally starting the equity raising period in September and will be closing on the first tranche of houses at the end of the month. There are 3 separate closings subsequently in November and December, giving investors time to plan if need be. The catch-up distribution mechanism rewards investors for investing early in the equity raising time period by effectively doubling the rate of preferred return to that investor. At the time of permanent financing in February of 2026, the catch-up distribution is a one-time cash payment to account for all returns owed to that investor to the point which for the catch-up distribution is double the rate of the regular preferred return per share class. To summarize, come February, we plan to close our permanent financing and then immediately pay out the catch-up distribution of the accrued interest and preferred due as a one-time payment. Then we will be actively managing the portfolio, providing monthly distributions of cash flow, and plan to sell the portfolio in 5 years. We have designed the portfolio to have multiple exit strategies, such as a sale to institutional investors, a REIT exit, sale to primary home buyers. And since these are quality assets, we can also choose to refinance the portfolio, or best of all, for those that are interested, 1031 sale the portfolio and acquire a new one to reduce our capital gains tax exposure. With a $100,000 Class A investment in the top left, we project to return over $147,000 over the 5 years. I'd recommend looking at the lease-up column, which results in a $4,730 or 7.5% annualized cash on cash, and then over $8,000 or 8.6% in distributions for 5 years until exit. 100% bonus depreciation and cost segregation studies will result in a significant tax shield for 2025. If we look at the 32% tax rate on a $100,000 investment highlighted in blue, results in $69,267 in a 2025 tax loss attributable to the investor. Once multiplied by the tax rate, that results in $22,166 tax shield to limited partners, or a 22.2% tax-adjusted cash-on-cash return from the tax benefits alone. With a $100,000 Class B investment in the top left, we project to return over $180,000 over the 5 years. I'd recommend looking at the lease-up column, which results in a $3,673 or 13.6% annualized cash-on-cash return, and then 7% or over $7,000 annualized, but paid monthly for 5 years. Once we sell the portfolio, an additional $41,843 is projected from proceeds at sale, resulting in over $80,000 of profit or an 81% total ROI. Once we include tax savings, the IRR increases to 22% and average cash on cash increases to 10.5%, down at the bottom right. If we look at the 35% tax rate on a $100,000 investment highlighted in blue, that results in $69,267 in 2025 tax loss attributable to the investor. Once multiplied by the tax rate, that results in $24,244 of tax shield to limited partners, or a 24.2% tax-adjusted cash-on-cash return. Finally, Class C, which increases the total ROI to 85% over 5 years, resulting in a 22.7% tax-adjusted IRR and 10.6% tax-adjusted average cash-on-cash, down there at the bottom right. Our highly experienced management team starts with our founder and chief executive officer, Matt Sinclair. He has closed over $35 billion of transactions through over 15 years of private equity and investment banking experience. He has extensive professional knowledge across sourcing, capitalizing, structuring, and executing transactions. He spent the majority of his career at JP Morgan, where he was part of the real estate investment banking team. Next is our founder and director of home building, Jim Reedy, who has over 50 years of real estate investing, construction, and property management experience. He has completed over 8,000 real estate transactions on behalf of retail and institutional investors. Next is Brad Reedy, founder and director of asset management. Brad has 14 years of industry experience and has completed over 6,500 transactions. He worked with institutions such as Cerberus, Man Group, and Building and Land Technology in roles of acquisitions, development, and asset management on over 1,700 single-family rentals. Then there's me, Mark Hart, founder and director of investor relations. I'm one of the top realtors in Tennessee with over $200 million of residential rental property transactions. I'm also the managing partner at Memphis Investment Properties, the highest rated turnkey provider in America, and own 685 multifamily units as a general partner on behalf of investors. Then there's Buck Buchanan, founder, director of construction. He is the director of construction for Value Home Maintenance, our in-house maintenance and construction company that completes 8 figures worth of work on an annualized basis. Next, there's Richard Jones, the director of investment strategy. Richard has served as the CIO for a single-family office, and he advises a land development platform controlling more than $1.5 billion in single-family lots across the U.S. Finally, there's Andrew Glisson, the director of strategic partnerships. Andrew is the founder and managing partner of Neighborhood Revival, a private real estate investment firm that holds over $25 million in real estate assets. And he's also a partner in LPS, which is Memphis's largest short-term rental property management company that is projected to host over 10,000 guests in 2025. Below is a case study for our previous fund, MIP Capital Partners Core Plus Fund II, which we successfully closed our permanent financing in May of 2025. Our rental demand exceeded expectations as we projected 60 days to lease the properties, but we were able to achieve this in only 41 days. And our interest expense was also 39% lower than projected. We were also able to initiate distributions to investors a month earlier than we were forecasted due to our strong performance. Best of all, limited partners experienced roughly 9% equity value creation relative to their initial equity basis as the properties appraised higher than projected while we purchased them at a discount. We have strategic partnerships with best-in-class home builders to provide meaningful returns to investors without the risk of on-balance sheet development. Reedy & Company Realtors will be providing the property management services, while Value Home will be providing ongoing maintenance. Due to the size of the fund, we've been able to negotiate terms that are more favorable than market, resulting in a higher ROI and more cash flow to investors than with direct ownership. To increase returns and reduce the fund's risk, we're deploying a real estate private credit cash management strategy. The fund will be lending to Memphis Investment Properties, which is the highest rated turnkey provider in America. And we have originated 828 loans since 2021, and we maintain a 100% repayment rate. All loans will be 100% secured first lien position, and these loans are not available to the public, and all interest and origination fees the fund receives will accrue to limited partners. Now I'd like to introduce Andrew Glisson, the Director of Strategic Partnerships, to discuss the portfolio.
Thanks, Mark. Now let's talk about the market environment that we're investing into. The Memphis MSA is experiencing a surge in large-scale corporate and infrastructure investments. Roughly 34 billion of projects are underway, which is equal to about 1/3 of the entire Memphis economy. To put that in perspective, it's like injecting decades of growth into just a few years. For a city of Memphis' size, this scale of capital investment is really transformational. It creates new jobs, it drives in-migration, and amplifies housing demand across the suburban markets where we're focused. Here, you can see the scope of major developments underway. From Ford's Blue Oval City to Google's new data center campus, in total, again, more than $34 billion worth of projects are being initiated, representing about 1/3 of the region's GDP. These investments are creating approximately 16,000 new high-quality jobs, which directly fuels housing demand in the surrounding suburbs. And importantly, this is just the beginning. In addition to the projects that you see here, there are significant additional developments in the works, including Dell and NVIDIA expansions tied to the AI and advanced computing boom. Memphis is positioning itself as a hub, not just for logistics and healthcare, as we've been known, but also for next-gen technology infrastructure. Population growth is another key driver. Suburban submarkets across the Memphis MSA are experiencing elevated growth, largely from people moving out of the urban core into the suburbs. Families are seeking larger homes, A-rated schools, safety, and modern infrastructure, all of which our properties are positioned to provide. But it's not just local moves. We're also seeing in-migration from people priced out of more expensive areas, both on the coasts and in nearby high-cost cities like Nashville. Memphis offers the same access to jobs, space, and amenities at a fraction of the cost, and that affordability gap is drawing new residents into the metro. Now let's turn to the portfolio itself. We're acquiring 36 newly built Class A single-family homes spread across 3 strong growth submarkets and 8 developments. These homes are individually selected based upon specific criteria and designed with long-term tenants in mind. They have open layouts, granite countertops, stainless appliances, 2-car garages, private yards. They're built by the best local home builders and located in safe, desirable neighborhoods near schools, jobs, and amenities. This isn't scattered site housing of mixed quality. It's a carefully curated portfolio, sufficient as owner-occupied homes, and that attracts quality tenants and minimizes operating risk. Here's a look at the detailed portfolio, addresses, floor plans, rents, and pricing. The average home is about 2,400 square feet, 4 to 5 bedrooms, renting for around $2,650 per month with an average list price of $430,000.
Thanks, Andrew. We are basis-focused, value-oriented investors, and we place a great deal of emphasis on making our money when we buy. We are purchasing the houses at a highly favorable valuation as measured by various objective measures of value. And that's what this page, which we refer to as a football field, is showing. See in the top left, we've got the discounted purchase price, replacement costs, list price, sales comparables, and then our measure of intrinsic value. And our home builder partners are willing to sell these high quality homes to us at discounted prices because we're buying in volume, we represent certainty of closing, and we're repeat buyers. So you can see that discounted purchase price is actually below replacement costs for these houses, and it represents a 10.2% discount to list price. And the most important takeaway on this slide is that the discounted purchase price is approximately 14.7% below our estimate of the intrinsic value of the portfolio, which is based on the present value of the future cash flows. So these charts show the projected equity value creation to LPs in February 2026, post-permanent financing, before catch-up distributions are paid. So in the top chart, you can see we're estimating that LPs will have a total equity value that's approximately 13% higher than their initial basis. And this equity value creation to LPs is achieved without taking construction or development risk. And we've used fairly conservative assumptions and factored in all debt payments and so forth to arrive at these figures. The bottom chart applies the same logic, but assumes the intrinsic value of the portfolio. And you can see that by this measure, there is significant upside to LPs. So we always like to take a look at sensitivity tables just to make sure that as different variables are flexed, we can see the outcomes on the overall results. On the left side, you can see that the IRR to Class A limited partners is not at all sensitive to changes in the key variables. And this is by design. Class B in the middle, it shows a high degree of sensitivity to annual appreciation and the interest rate that's achieved on the fixed rate permanent financing in February 2026. But critically, the middle column, Class B, doesn't show very much sensitivity to the rate of vacancy as a portfolio normally would. And this is largely a function of the very beneficial impact that direct lending has to this portfolio. So you can see that the variability of negative outcomes is significantly made less severe through the presence of direct lending. Class C on the right side, it shows the same characteristics as Class B, but the IRRs for Class C are slightly higher due to the enhanced economics that Class C shareholders have. So I think the key takeaway from this page is that our results hold up quite well when faced with adverse conditions. So this is a summary of our scenario analysis. So we form our base case based upon a thorough analysis of historical norms for the markets and the product. But we also want to understand what our upside case looks like, and then the credit case. And a credit case is basically a downside case. We want to ensure that when faced with adversity, we're able to make our distributions each month to investors, and that in all periods in the credit case, we're able to meet our debt obligations. And I can say with confidence that in every single month throughout the forecast period of the credit case, we meet our distributions and meet our debt payments. I think a first key takeaway on this page is that across the scenarios, the cash on cash returns are the same. So that's very, very beneficial. It's good to know. It means that regardless of the scenario, we're able to make the payments, the distributions that we promised to investors. So I'm very happy with how that works out. And we would not have pursued the deal had that not been the case. Another key takeaway here is that the IRRs in the credit case are still quite favorable because the risk of the deal is fairly low. So in theory, you're getting a reasonable core plus return level here, despite post lease up, it is a core risk profile. I think the final takeaway here is that the tax impacts are meaningfully beneficial. And to some degree, that's a reflection of the updated legislation that we were made aware of in July. And so we worked with a national real estate focused accounting firm, I think one of the better firms in the country, and worked with them for 3 weeks to build out in great detail and specificity the exact impacts of this new legislation and what that would mean for our limited partners. We were very thorough and careful in capturing the benefits from a financial modeling perspective. So this page shows the tax adjusted IRRs by share class at different tax rates, and of course the corresponding capital gains tax rates for both a 1031 sale and acquisition scenario and a scenario where the sale occurs without a 1031 exchange. We wanted to make sure that we were in full disclosure showing both cases to investors, but you can see that the tax benefits are quite meaningful in both cases, and they're especially meaningful for individuals in higher tax brackets. So this page shows how we arrived at the average annual tax-adjusted cash-on-cash return metrics for each share class by tax rate. And very interesting, you can see that the impacts of the bonus depreciation, because it's 100% bonus depreciation now, they create a significant tax-adjusted cash flow benefit in the calendar year 2025. So it's interesting because our cash distributions don't begin until the February of 2026, but from a tax-adjusted perspective, there's an enormous benefit in calendar year 2025 because we're placing the assets in service in 2025. And even though it's in the latter part of the year, with bonus depreciation, you can realize a full year of bonus depreciation, irrespective of when in the year you place assets in service. So you can see this has an incredibly positive impact for LPs. This legislation has meaningfully improved the impact beneficially versus what it was prior to the changes. So the timing is opportune for this investment to take advantage of the positive tax benefits for 2025.
All right, thanks, Matt. Next is the partnership structure summary page. This is great to get a high-level view of the equity share classes, the return summary, the waterfall, and the fee schedule. Going over the Class C waterfall in the top right-hand corner, the investors will receive an accrued but unpaid 8% preferred return. Then they will receive 100% of their originally invested capital back. Then an additional preferred accrual of 3%. This is paid at exit. And then finally, any distributions above that 11% preferred return, those are going to be split 90-10, which is 90% to the LP and 10% to the GP. Here's the execution timeline, which has been designed to be flexible and resilient across different potential market scenarios. We'll be raising equity throughout the fall of 2025. And then October to February, we will be leasing up the properties and stabilizing the portfolio. Then in February, we plan to put permanent financing in place. That's when we'll pay out the catch-up distribution to LPs. Then years 1 to 4, we'll be providing recurring monthly distributions. This is going to maximize cash flow and returns to the investors. And at year 5, we plan to sell to an institutional investor, a REIT, but we can also be flexible and exit to individual homeowners. We could refinance or even 1031 out and acquire a new portfolio for those that are interested. Ultimately, the main goal is that we want to be flexible and have multiple exit strategies. For those that would like to move forward, you can visit our website at MIPCapitalPartners.com and you can click the investor portal. This is going to be in the top right. Then if you're new, you can click register now to invest. So if you don't already have an account, and then you can follow those steps. Inside the portal, you will find the full confidential information memorandum. You'll find the private placement agreement, the operating agreement, and subscription agreement. In the portal, you'll be able to sign the subscription agreement and upload your accredited investor verification letter. To receive this letter, you can visit verifyinvestor.com or obtain a written confirmation from a registered broker-dealer, an investment advisor, an attorney, or your CPA. Ultimately, anyone investing over $200,000 is considered accredited, and does not need to have a letter on file. Then you'll be able to confirm the wiring instructions in the portal and wire your funds to the company bank account. Please make sure that you email me your wire confirmation. My email is mark@memphisinvestmentproperties.net. Once received, I'll then confirm when the funds have cleared and that you've been accepted into Fund III. All right, that's it. And we'd like to thank everyone for your time. And if you have any questions or comments, please don't hesitate to reach out. And we look forward to hearing from everyone.